Welcome to a new video on my channel. I hope you're doing fine. And since I did a video on my expectations for the Q4 and the fiscal year 2021 for Sofi, I wanted to make a follow-up video on what the actual results were and what the points I wanted to have a closer look are looking like. So before I want to start, this is no financial advice, this is my private personal opinion only, and this is no recommendation to buy or sell any of the companies I mentioned in this video. So the growth has been really nice as well in this last quarter and in the whole fiscal year 2021. Member growth was very fast, as you can see, year-over-year growth up to 113%, which is amazing, and it's on a high level. Same also for the products, it's even higher, and it's 3-digit growth in the last six quarters, which is amazing, and therefore everything is fine on this side. The number of Galileo accounts has also been steadily rising as well. The growth rate is not that high anymore, not 3 digits, but still around 70%, which is a really good value. And also the lending product has been growing for between 12 and 25%, which is in general a good sign. However, it slowed down in 2021, but still 12 to 18% is a good number in my opinion. And the financial services product has been growing rapidly, however, beginning from a really small value, and therefore it's not that significant right now, but it's good to see that it's growing very fast. So I think it's good to see that they have a record revenue and also positive adjusted EBITDA numbers for the quarter, and I will come back to the actual numbers for the fiscal year 2021 in a second when I switch over to my presentation. What I think is always good is that the company has met the expectations, or at least their guidance, and are on the upper side of the guidance. This is not only true for the quarter 4, but also for the full year 2021 guidance. And for the first quarter of 2022, they have a narrower span of the revenue, which I think is a good sign that the company or the leader of the company knows their business well, or at least think they know their business well. We'll see in a few months if they were right or not. And also it's interesting to see how the effect of the moratorium has, which I think it's really interesting that it has between 12.5 and 17.5 million adjusted net revenue per month, which is missing right now, and which would have been added on top if there was no moratorium. And the same for the adjusted EBITDA, but it's a little bit lower. The impact, it's 7.5 to 12.5 million per month. And so keep in mind this probably will be added on soon, at least if the moratorium will be finished in May. So that's something to keep in mind. And also, which I really like, is the transparency that they put out the numbers for the stock-based compensation expenses, which is quite high, I think, but in general it's positive if they're transparent about it. And also the overview from 2019 till 2022 guidance, and as you can see, the numbers grow on both sides pretty rapidly. On the upper part for the adjusted net revenue, it's good growth. However, unfortunately, there's also a high growth on the stock-based compensation expenses from 61 in 2019 over 101 in 2020, and then a big jump to 2021, and there should be even more, around 90 million more for the 2022 to stock-based compensation. So they also provided some numbers for the different segments, and as you can see, it's a bit small, but I might zoom in later on. It's easier to have the overview right now, I think. It's the personal loan originations have been really high in 2021, or almost doubled from 2020, and the contributing profit of the whole lending segment was around 400 million, and in comparison the technology platform Galileo has about 64 million. However, it's interesting to note that the numbers of accounts or Galileo accounts has been rising fast, I think, and the net revenue is not increasing that fast. However, on a positive side, the directly attributable expenses are not rising as fast as the net revenue, and from Q3 to Q4 the expenses has been even lower, so there's scalability, which is a positive sign in general. And the financial services segment, which is losing around 135 million for the last fiscal year. So if you have a look at the gap number, the gap loss right now is around 484 million for the fiscal year 2021, and I marked it over here. The stock-based compensation is around 240 million, so it's a huge part of these losses, which is something to keep in mind. And with that being said, I want to switch over to the points which I've been addressing in an earlier video. So what I'm looking at for the numbers. That was the first one, member account growth, and especially how about the cross-selling, if it's working or not. Later on, the guidance for the fiscal year 2022 and details about the bank charter. And lastly, the road to profitability and especially the stock-based compensation. So if you have a look at the cross-selling, if you check the Q4 2021 developments, the number of products increased around 21%. However, the number of members increased only about 18%. So you can see that for every member you get more than one product or new product. So there's cross-selling right now, at least in the last quarter. And if you have a look from or since first quarter of 2019, there's around 5x of the amount of members. However, there's around 6.6x from the amount of products. So as you can see, there's also a sign for cross-selling. And I tried to plot this on a graph, and in the blue bars you can see the amount of products per member, which is steadily rising from around 1.1 to almost 1.5 products per member in Q4 2021, and the average raise from the previous quarter is around 2.8%, and there was only one quarter with negative growth rate. In general, I think it's a good sign, and hopefully the amount of new products or the amount of products per member is increasing steadily. This would be a good sign. Then the adjusted net revenue reality versus projections, which I think is really important to have a look how are the projections of the initial investor presentation of this pack, since there have been a lot of companies which have been pretty aggressively, I would say, with the projections. However, Sofi has been on the one hand or either conservative with their guidance, or they are executing pretty well, or a mixture of both. And if you can see, the projection for 2022 is around 1.6 billion net revenue, or 1.57 exactly, so it's higher than the initial projected revenue numbers, despite the fact that the student loan moratorium is still in place, and therefore there, as I showed before, around between 12.5 and 17.5 million revenue per month is missing. So if you would add it up, there would have been a pretty considerable beat, which in general is a good sign in my opinion. Also makes me more confident that the projections for 2023 and later will be at least reachable. So next part, which unfortunately is not that positive, I think, is the net EBITDA. Same as before. What are the projections in blue and what are the actual numbers? 2022 and 2021, they beat their own projections. However, in 2022 they lowered the initial number they put out from 254 to 180, which is quite significant. Unfortunately, I couldn't find any reason for this, and also not in the conference call. So if you have any idea why this might be the reason, please let me know. It'd be really interesting to hear that. So I will also discount the likelihood of it being realistically decent numbers in the future, but yeah, I'd be happy if they surprise me on a positive. So on the last part of the video, I want to have an overview about or give you an overview about the stock-based compensation, and again the development from 2019 until the projection for 2022. And as you can see, well, I showed you before also, the development has been pretty aggressive, from 61 to 240 million within 2 years, which is 4x. And in the yellow line you can see the year-over-year growth, and in gray you can see the amount, or the amount of revenue which is given out in stock-based compensation, which is pretty high. I'd say around 20 or between 20 and 25% for 2021 and 2022, and it's around, at the actual market cap of 6.3 billion, it's around 5.3% of dilution. So this is something to keep in mind, and which I'm not happy about. However, I understand that it's important to get the best talent, and therefore you have to have some lucrative compensation. However, the growth was, in my opinion, too fast, and I hope the growth will slow down for the stock-based compensation, while the revenue and adjusted EBITDA projections will, or the numbers will further accelerate the growth. So this is my hope. However, if you have a look at the road to profitability, and therefore I will be switching back to the initial investor presentation soon, because they projected that they will have a profitable net income on a GAAP basis on the end of fiscal year 2023. However, I think this is unlikely right now, since the projections have been pretty accurate until one number, and this is the stock-based compensation, because as you can see, they estimated between 94 million and 144 million in 2025, which is right now a lot lower than numbers for 2021, with around 240 million, and even more lower than the 2022 projections. So in the future these numbers will also rise, and therefore the year of profitability will get pushed further back, unfortunately. The other numbers have been in line with their projections, and therefore this leads, in my opinion, to a later date until the company will get net positive per GAAP. So yeah, this is the bad part in my opinion. Otherwise, I really like the company and the development, and I'm really interested in what the company will do in the future, and will be interesting to hear what you think about the company. And until next time, I hope you're having a good time. Bye bye.